Hello and welcome to this December edition of Property News. Today I'm going to give you an update on the UK economy, talk about what's happening right now in the property market, and I have a brand new section that I'm temporarily naming Property Ramblings, which I know is a terrible name. If you've got a better name for it, please comment below. So my name's Tony Law from Your First Four Houses, and my channel's all about helping you replace a job-based income with just a handful of investment properties so that you can give up the day job if you wish and go and do something more interesting with your life. If this is your first time here, be sure to subscribe to the channel and click that bell notification icon so that you don't miss out on any of the free content that I give you each and every week. So let's start things off by looking at the economy. At the end of November, Rishi Sunak set out his spending plans for 2021 and he gave his views on the current state of the UK economy. Now there is a huge amount of data that I could cover here, but instead let me just pull out some of the major highlights and I'm going to leave links to more details below. So it looks like the UK economy is set to contract by 11.3% in 2020, which is the largest fall for more than 300 years. However, he forecasts the economy is due to grow by 5.5% next year and 6.6% in 2022, although output levels are not expected to reach pre-COVID levels until the fourth quarter of 2022. Sadly, unemployment is expected to rise and reach 7.5% by the spring, with 2.6 million people out of work. Although the Chancellor was really keen to make it clear he's introducing a new £4.6 billion package to help people get back into work, and he's also allocating £2.6 billion to a restart scheme which supports people who have been out of work for more than 12 months. Borrowing is forecast to hit £394 billion this year, which is equivalent to 19% of GDP, the highest level ever recorded in peacetime. He added that underlying debt is forecast to rise to 91.9% of GDP this year and a staggering 97.5% in 2025/2026. With regards to Brexit, talks have resumed and negotiators are racing to reach a deal before the January deadline. If there is no deal, the Office for Budget Responsibility has estimated the UK's economy could shrink a further 2.1% on top of the projected impact from COVID-19. Sadly, in retail, Arcadia, which owns Dorothy Perkins, Topshop and Burton, has collapsed, putting 13,000 jobs at risk, and Debenhams is also set to close, putting a further 12,000 jobs at risk. Sadly, the loss of these giants of retailing will only add to the number of empty shops on the high street, but of course it's those sad people that are losing their jobs that we all, of course, feel really sorry for. As always though, I've got to end this section on just a little bit of a positive note, and this month it is definitely a biggie. According to the highly respected React 1 study, the R number has fallen to 0.88. And with vaccines now rolling out, I think we obviously finally have something that we can genuinely celebrate in the run up to Christmas. By the way, if you're finding this update in any way helpful, it would just be awesome if you could take a moment to click on that like button down there. It really helps me if that's okay. Okay, so moving on to property. The average price of property coming to market has dipped slightly by 0.5% compared with October, despite continuing strong buyer demand as new sellers join the rush to sell and beat the March stamp duty deadline. Perhaps unsurprisingly, activity is highest in the price bands where buyers are set to make the biggest stamp duty savings. National sales agreed are up 50% compared to October 2019, and it's estimated that there are currently 650,000 sales going through right now, which is 67% more than this time last year. Buyers who were temporarily uncertain in the run-up to the latest lockdown appear to have jumped back into action, as we're currently seeing demand up by 49% again compared to this time last year. Last month, I reported the issues regarding sellers of flats being unable to sell because lenders were insisting a seller produces something called an EWS1 certificate, which is basically a report that's carried out by a surveyor stating that the building is safe. And by safe, I mean it doesn't have any dangerous cladding or anything like that. However, On the 21st of November, the Housing Secretary announced that homes without cladding would no longer require an EWS1 certificate when selling. This is obviously huge news for the hundreds of thousands of flat owners left in limbo, and that actually includes Liana and I, although at the time of filming, lenders have stated they do not consent to this announcement, so hopefully I'll have a bit more news on this next month. The number of mortgage deals available for those with just a 10% deposit has increased by 25 to 81 during November, which is brilliant news for first-time buyers. And it's now at its highest level since the 1st of June 2020. And lastly on property, Rishi Sunak has announced a review of capital gains tax and has expressed a desire to bring capital gains tax in line with income tax rates, which of course is really worrying for landlords. Capital gains tax is currently charged at 10% and 20% for most taxable assets, or 18% and 28% for residential property that are not somebody's main home. However, income tax is charged at rates of 20%, 40% and 45%. This could obviously mean some really big hikes in capital gains tax, which is why you must speak to a property savvy accountant before you buy that next or maybe first investment property. Okay, so on to my brand new section, which is Property Ramblings, which kind of replaces my predictions and to-do list, which to be honest with you, were kind of a little bit ungainly. So I thought I'd introduce Property Ramblings. But if you've got a better name for it, please feel free to comment below and I'll probably use that name instead. It's kind of just like a grouping of my thoughts on where we currently are. So hopefully you're going to find this section helpful moving forwards. So the first thing I want to talk about is capital gains tax. To be really honest with you, I honestly think it's coming in. How could it not come in, considering the amount of debt that we're currently looking at as a country? So capital gains tax could now have a really big impact on those sellers that want to sell. So here's a thought for you. Maybe if you're speaking to landlords with multiple properties that they're looking to offload, they've got a portfolio, they're looking to offload them, and you're actually looking to organise some kind of a deal that's maybe geared around using property options, which you are hopefully familiar with, perhaps you can work out a system whereby you end each property option agreement staggered at yearly intervals. And this way the seller can actually maximise their capital gains tax allowance. Now, I am not actually allowed to give you financial advice. And so if this is something that you're interested in, please, the only person you should be speaking to is that property savvy accountant. So make that call, spend the money, it will be a good investment of your funds. Next, I want to talk briefly about stamp duty holiday extensions. I have some great friends in the property industry. We've had a chat about this, and to be honest with you, we're all of a like mind. We think that the stamp duty holiday probably will be extended, maybe pushing it all the way back into the end of the summer. We all felt that COVID, which is obviously all we're talking about and thinking about right now, could actually be, we could be finding ourselves in a situation whereby by late spring, we could be back to some semblance of normality. And I can't help smiling as I'm saying that because it just seems so weird saying it from our current viewpoint. But with so many hugely positive things being said right now, obviously the vaccine being the big one, is it possible that by late spring, we could be back to some semblance of normality? How awesome would that be? We also felt that there's going to be a Brexit deal done probably at the 11th hour. And I personally think that's going to be nothing but a good thing. And the last thing I wanted to share with you in my ramblings for this month was this. I honestly think we're at a point now where, sadly, so many conventional jobs, they're just not stable anymore. I think this has been actually a transitional thing over a period of time, but I do really feel that right now, so many of those fundamental core jobs, they're just not stable. So I want to ask you to do something. I want you to think like this. No longer should you be reliant on one job moving forwards. I think there's a strong argument now for you to diversify what you're doing in terms of bringing in income. Obviously, I'm always going to wave the flag for property investing because frankly, I wouldn't be where I am now were it not for the fact that I've got a nice healthy little portfolio that's kind of giving me a really good income. So I'm always going to fly that flag. But maybe property isn't right for you. Maybe you need to look at other sources of income. The point being here, I don't want you to rely on just that one job-based income. And if it is property that you decide to go down, maybe you just look at doing this over a part-time basis. So put some of your time to one side so that you can slowly start building yourself a bit of a property-based portfolio and get yourself to that place of financial freedom like Leona and I am. Obviously, if I can help you in any regard moving forwards in this capacity, I'd be delighted to do so.